Okay. That's a little better. So risk management. How do you, for your own personal finances and life, how do you manage risk, right? We cannot eliminate all risk from our lives. How could you do that, right? You can't. There's always going to be risk. But how can you manage that risk so that you don't have too much? So you have an acceptable amount of risk. For example, to get here, you might have traveled on a road, right? In a car, in a bus, on a bicycle. There's risk involved, but it's reasonable risk, right? You've calculated that you feel fairly safe traveling that way, well, hopefully. And so you were willing to accept that level of risk. So that's really what we're talking about. How do we identify what risks exist and then make sure that there's an acceptable level of risk? Right? I could have sworn this was working a moment ago. So there are different types of risk. One type is something called longevity risk. The risk that you could outlive your money. In other words, you run out of money at some point as you're getting older, but if you're already in retirement or don't have good health or just you're at an advanced age, it might be difficult to earn money. It might be harder to get a job, might have certain limitations. So one way to manage that longevity risk is to use what insurance companies call an annuity. Now, we're familiar with that term annuity from our chapters, the one on the time value of money, remember? We had those tables, like the present value of an annuity, right? Future value of an annuity. And I told you at the time that an annuity was any time you either put money in on a regular basis or you take money out on a regular basis. But in the context of insurance companies, when they say annuity, what they mean is that you have some sort of account with that insurance company where they're going to give money to you on a regular basis for a given period of time. Okay. As it says here, it could be for the rest of your life. That's one really neat thing about these annuities is, let's say you retire at age 65 or 70. You don't know if you're going to live 5 years or maybe another 30 years. Or the way medical technology is going, maybe even longer than that. So you might spend more time in retirement than you actually spend working. That is true for some people. I mean, maybe work for 40 years and then they're retired for 50 years. So imagine getting to that point in your life where you retire and knowing you've got a stream of money that's going to last your entire life. That would be kind of reassuring. That doesn't mean it's necessarily enough money for all your needs. I'm just saying, you know, it'll keep coming for the rest of your life. Well, how do insurance companies do that? How can they offer that? Well, remember that they hire actuaries. They hire people whose job it is to calculate how much to charge. And they calculate that if you put a certain amount of money into this annuity, the insurance company can invest it in bonds and grow it at a very safe rate. And they can afford to make these payments to you for as long as they calculate that you are going to live. Now, if you're healthy, you might live longer than they calculated. It doesn't matter, they have to keep paying you the money. So if you're in good health and your family has a long life expectancy because everybody in your family lived many years, this kind of a guaranteed income stream for life might be good. You might actually, you know, be in a good position to really milk that insurance company, right, for as much as possible. But you might be thinking, but what if I don't live that long, right? What if somebody has one of these annuities and then who knows, something happens and that they don't live that long. It used to be that the insurance companies just kept the rest of the money. So that was kind of the gamble. You hope to live a long time and get all that money back, but if you don't, they keep the money. These days, it usually doesn't work that way. With the annuities that I've seen from life insurance companies, you put in a certain amount of money. That money, depending on what type of annuity, it might even grow for a period of time. But whatever portion is not used up goes to your beneficiaries. Now they're still making some money. They're still, investing your funds, and maybe they're keeping the interest to some degree, right? They have to have some profit out of the deal. But it's not like you're risking losing the money, because it'll at least go to whoever you identified as your beneficiaries or your heirs. So that's how annuities basically work. You put money in, so you get this income stream, either for a specific period of time. If you want to get bigger payments, you could say, I only want it for 10 years, or I only want it for 20 years. Or if you're willing to accept a smaller amount of money in each payment, it could be as long as the rest of your life. Now, a lot of times there are no fees for these annuities. So one way that they guarantee as a life insurance company that they're going to make some profit is they require you to keep this annuity for a certain number of years. I've seen anywhere from 5 years to 14 years. That if you cancel the contract before that time, then they charge you a fee. They call it a surrender fee. Usually they'll let you take out at least 10% of the money per year if you need it. So like, let's say there was some big medical emergency, or car broke down or something, and you needed to take out some of the money that you put into the annuity, you can usually take out 10% per year without any penalty from the life insurance company. But if you needed to take out more than that before the contract period, they might charge you an additional fee. Now, there are a couple different varieties of these annuities. There's what's called a SPIA, which is single premium immediate annuity. That's when somebody has a sum of money, a lump sum. They turn it over to the life insurance company, and they immediately start taking the income. So imagine you won the lottery. You're like, okay, I just won $500,000, had to pay $200,000 in taxes, so I've got $300,000. I'm afraid if I put it in my bank account, I'm going to spend it. Maybe instead I'll put it into an annuity. If you're old enough where you can start taking money out of the annuity, then you could have an income stream for the rest of your life. So maybe it's paying you out, whatever, certain amount of money every year for the rest of your life, or even every month. So that's how you might use one of these immediate annuities. What's more common is people don't have a large sum of money to put in at one time. So maybe they contribute to that annuity, just like you would into an IRA. You put that money in on a regular basis, it grows over time, so that in retirement, then you can start taking the income. The annuities sometimes give you a fixed rate of interest. So the money that you put in grows at a guaranteed rate, usually not very high. I'm guessing, I haven't really looked recently, but I'm guessing right now maybe you can get 3 or 4% guaranteed growth in an annuity. But they have some other variations. They have what's called an indexed annuity, where, remember when we talked about stock market indices, right? Like the S&P 500. So if you have an indexed annuity, it's tied to an index. So if that stock market index goes up, your annuity goes up. However, you don't go up as much. So maybe the stock market, let's say the S&P goes up 10%, your investment in the annuity goes up 5%, something like that. So you don't get the entire upside. But you're not actually in the stock market. With these indexed annuities, it's just tied to the market in terms of what rate you get, without actually being invested in the market. And the cool thing about these is when the market goes down, you don't lose anything. The market goes up, you get a certain portion of that upside. Market goes down, you just stay wherever you are. I've used those a lot in the past with my clients who were either in retirement or they were getting close to retirement. And they wanted to grow their money. They wanted more than what they could get with the fixed annuity. But they also wanted to make sure they didn't lose any money based on market changes. So that was a pretty good solution for those clients. Then there are variable annuities where the money that you put in to the annuity actually does get invested into the stock market. And you can actually lose money in a variable annuity. So you probably get more of the upside when the market goes up, but you could actually lose money if the market goes down. So these products can be kind of complicated. They used to have a really bad reputation, but from my experience in the last couple decades, life insurance companies have come up with really good annuity products that work really well for some clients. So any questions on that as a way to reduce your longevity risk? Try to make sure you don't run out of money. Howard?
Is it typically only people who are, like you said, like getting close to retirement? So people like in the early ages of age wouldn't try to get an annuity?
Most people don't start to think about it until later in their career. However, if you're working with a financial advisor, it should be something that they consider for you, because just like with any sort of investment, the earlier you start, right, the more it can grow. And I've seen some of these annuities have guaranteed growth of even 7%. Now, anything you invest in the stock market, there are never guarantees. There are no guarantees in the stock market. You can always lose money. But life insurance companies can make guarantees. They can say, we promise you that this money will grow at this specific rate. So they're taking the risk. If they don't manage the investment well enough, it doesn't matter. They've made that promise and they can guarantee it. So that could be a really nice feature if you're getting a guaranteed 7% growth, for example, and that builds up. If you remember the rule of 72, that would mean your money's doubling every 10 years. But then if you're contributing on a regular basis, it's growing even faster. So yeah, it can be a really smart thing to start doing. Now, we'll get to also universal life policies. Those are another option. I think it's more common that younger people will do a universal life policy, which right here. So I'll explain that and how that might be another approach instead of an annuity. So let's talk about life insurance. Again, annuities come from life insurance companies. And one way to think about it, the annuity company loses the longer you live, right? Because they have to keep paying out that annuity. If you have a lifetime annuity, the longer you live, the more it costs them. With a term life insurance policy, if you die, they lose money. So it's kind of the opposite. Now, a lot of people don't know the life insurance is not just something that will pay out money to your beneficiaries. Let's say your spouse or kids or whoever you are financially responsible for, who would be hurt if your income was not available anymore. It's not only for those people. There are now often these things called riders. A rider is just like a feature of a life insurance policy that you can use while you're still alive. So here are some examples. This is a very common one these days. A lot of life insurance policies, if you were to develop a terminal illness, God forbid, would allow you to cash out that life insurance policy while you're still alive. So let's say it was a $100,000 policy. So if you die, $100,000 goes to your beneficiaries. And, well, in fact, I'll give you a specific example. I had a couple who were clients of mine many years ago, and they were an older couple, and they wanted to each have life insurance policies. The husband didn't qualify, so we couldn't get him a policy because he had health issues. But the wife passed the medical exam. We got her a life insurance policy for $150,000. So the policy cost them $1,000 a year, approximately, for $150,000 in coverage, right? So the idea is, if she dies, her husband will get $150,000 that he can use for, whatever, pay off the mortgage, whatever they have to do. So 4 years go by. They've paid $1,000 a year for 4 years. So $4,000 is what it's cost them so far. And they contact me, the husband contacted me and informed me that his wife had developed pancreatic cancer, which is a really bad cancer. It's if you're gonna get cancer, you don't want that one, right? And the doctor said that she only had about a year to live. And he said, I remember you told me that we can get some of that money while she's still alive. And I said, yes, that's right. Let's call the company. So we did. And they ended up, it was a $150,000 policy. They sent a check for $120,000. So they didn't get the entire amount, but they got most of it. And then that was it. Then the policy was canceled. But they were able to use that $120,000 for medical costs or whatever they needed. And remember, they'd only spent $4,000. That's a good return on investment, right? Not that that's what you hope for, but the fact that you could use that while you're still alive, that's a very useful feature that a lot of life insurance policies have. Some will have a critical illness feature where if you get certain illnesses, it might specify like heart attack, cancer, certain illnesses, they will allow you to advance some of the money. Or chronic illnesses where you're not able to take care of yourself, but you might live another 20 years. They might have a feature where you can access the money. So that's a nice thing that a lot of people don't realize can be available in a life insurance policy. Now, the policy that they bought was a term policy. I think, it was a 10-year policy, which is pretty common. You can sometimes find shorter policies that are cheaper, but usually 10 is the most common way to go. You can get a 20-year policy or even longer, but then it's more expensive. Because the life insurance company again, they're calculating based on your gender, your age, your health history, your family history, your job, based on all these factors, they calculate how long they think you're going to live and what they should charge you for that policy. So if you go with a shorter policy, like 10 years, there's a greater chance you're going to outlive that policy, right? But the longer the policy, the less chance that is. So a lot of people will go with these term policies, very often 10 years, maybe if they've got a mortgage on their home, maybe they'll go with a 20-year or 30-year policy thinking that, hey, if I die before we pay off the mortgage, at least the insurance proceeds can pay off the mortgage and my spouse can stay in the home. So that's a common approach. But some people think it's throwing away money. Less than 2% of term life insurance policies ever pay out because people typically outlive them. So there's a pretty good chance, there's a 98% chance that you're spending money that you're never going to get back on a term policy. So what some people do is instead, they get a permanent policy. And as long as they keep paying the premiums, the annual or monthly cost, as long as they keep paying that, the policy lasts their entire life. But in that case, the insurance company is trying to forecast, okay, what's it going to cost to insure this person for their entire life? It's going to be a lot more expensive. Some of the nice things, though, about these permanent life policies, they build up cash value. So you're putting money in, and at some point in time, there's enough money that you put in there, you could actually take some withdrawals out of the policy, get back some of your money without jeopardizing your life insurance. Or you might take a withdrawal that reduces the amount of life insurance, but still, you get to just basically take that money out of the policy. Or you could borrow against your policy. And then when you pay it back, you're paying yourself interest. And it's tax-free. So a lot of rich people use these permanent life insurance policies to minimize their tax consequences and pass money on to their beneficiaries in a tax-efficient manner. Just like with the annuities, you could actually invest your permanent life insurance in the stock market, but then again, you're taking a risk because it could go down in value. There are also indexed policies where it goes up when the market goes up and you don't lose anything when the market goes down. So that could be a good solution. Those are pretty common. There are what are called universal life insurance policies. I'm not sure who came up with the word universal, but basically what it means is the amount that you pay is flexible. So if you go through a period where cash flow is really tight, you might be able to pay less towards your policy and have it still stay in force. And if you have a period where you've got extra money, up to a certain limit, you could put more money into the policy and grow up the cash portion faster. Again, it could be a neat tool. There are also what are called whole life policies. These have a fixed premium and a fixed rate of interest that they grow at. So these are probably going to be the most expensive option, but you know exactly how quickly it's going to grow and exactly how much your premium is going to be. So a lot of different options. And again, they could be used not only to take care of your beneficiaries or take care of yourself in the event of a terminal illness, but sometimes for tax purposes as well. or really as a type of investment. Life insurance is not supposed to be an investment, but in some ways it could be used that way. I should mention, not only are there health qualifications that you have to pass in order to get the life insurance, there are sometimes financial qualifications. So if you want a $2 million life insurance policy and you're making minimum wage, the life insurance company is going to have a lot of questions about why you need such a big policy. They might deny it, right? If it just doesn't seem to match your income level. But it's pretty rare. I think I've only encountered that once, where somebody wanted such a big life insurance policy that they had to provide their financial information. Christina? Well, I've seen for young people, cases where you can get a life insurance policy sometimes for $25 a month, something like that. It all depends on the carrier, its term or term, your health rating. So there are a lot of factors, but sometimes they're not that expensive. Emma?
I actually want to get a life insurance policy. Do you have recommendations? Like basically I want to.
So there are many life insurance companies out there to choose from. I would say in general, if you work with an independent broker that represents multiple companies, then you're better off. If you go to, for example, somebody who only represents New York Life, they can only sell you New York Life insurance, right? So they're going to be kind of biased and limited as far as what they can offer. So I would recommend that. You can also go to the California Department of Insurance website and look up, are there complaints against this life insurance company, whichever one you're thinking of going with. So that would be good to check on as well.
Can you shop around life insurance, like they would give, there's like the veteran, they do have one where I can, but I don't know if what I'm getting is less than what I should be paying. Like if I'm paying too much for this policy.
Yeah, okay. My guess is it's probably a good policy if it's through the VA.
But the limit is so low. Like the
Oh, okay. The face value is not as much as you want.
Yeah.
Okay. Yeah, you can compare. You could have a life insurance broker help you with that, or I'm sure there are online comparison engines too. Or I could take a look at it for you.
Okay.
Another factor in qualifying is if you are a motorcycle rider, if you like to do bungee jumping or parachuting, if you travel internationally a lot, these behaviors might disqualify you because they're viewed as more risky by the insurance companies.
Even if you travel for
vacation? Vacations, probably wouldn't be an issue, but it might be depending on where you're going too. So there might be certain countries where they would have a concern, even if it was just a vacation. Right, like if somebody were going to Ukraine right now. Right.
Yeah, like we usually travel internationally.
Yeah, that's not necessarily a problem. Yeah, as long as it's it's not a dangerous territory that you're going to, it's probably not an issue. All right. Any other questions so far on annuities or life insurance? Is that a question, Jack, or you change your mind? Okay. All right, let's talk a little bit about health and disability insurance. So as I'm sure you know, during President Obama's administration, he got some healthcare legislation through. Several presidents before had tried and it never happened. But he really focused the the first part of his presidency on healthcare. And he got the Patient Protection and Affordable Care Act passed, often referred to as the Affordable Care Act or just Obamacare. And as a result, something like 40 million Americans were able to get health insurance who before couldn't get it. Some of the things with that legislation, kids up to age 26 could stay on their parents' policy, which was something new. You couldn't be denied because of a previous condition, starting with Obamacare, whereas before, the health insurance companies could deny to cover you. What else? There were exchanges that were set up where you could get a subsidized health insurance plan if you met the income qualifications. In California, does anybody know what we call the exchange where you could get Obamacare health insurance? Covered California. So around the enrollment time, I think it's like towards the end of the year, you'll start to see Covered California locations pop up because they're trying to get people enrolled. So some people qualify through that insurance marketplace to get subsidized health insurance, so they don't have to pay the full amount. And that could save people a lot of money. A lot of times, though, we get health insurance from our employer. Now, most of the industrialized nations of the world don't do what we do. They usually just give everybody health insurance, right? But the United States, for whatever reason, we've set up this system where a lot of times you get it through your employer, which is good. Sometimes it's a good plan. Sometimes it covers a lot. Sometimes you have to pay a lot, even if it's an employer plan. When I opened up my farmers insurance agency, farmers had a health insurance plan for the agents. So I thought, oh, maybe I'll switch to that. I looked into it. I think at the time I was paying like somewhere between $300 and $500 a month to cover my family. Switching to this plan, it would have been $2,000 a month. I was like, no, thank you. And the reason is because a lot of the people who are on that farmers insurance agent health insurance plan were agents who had been in the business 30 or 40 years. So it was a lot of old guys, basically. And the cost of the plan that you get through work depends on who's in the plan, right? So in this case, it was all people that were a lot older than me, and so it was a lot more expensive. If I were 70 years old and wanted to get on that plan, maybe it would have made sense, but I was able to save a lot of money just staying with the plan I was on. Now, sometimes when you get health insurance, you can sign up for a health savings account. The way that works is the money that you put into that account, you don't have to pay income taxes on. So it saves you some money on your income taxes. That money you can only use for medical expenses.
And dental.
And dental and vision, that falls into that category. But
I don't know. Sometimes
and sometimes what?
Yeah.
Yeah, because mental health. That was another part of Obamacare, is that health insurance companies had to include mental health, whereas before they didn't. So yeah, so you could use it for anything health related, well, I mean, within reason, and saves you money because you don't have to pay income tax on that money. Flexible spending accounts are similar. Who can tell me what is the difference with a flexible spending account?
I think it's what you can use the.
Well, it's when you can use it.
Yeah, they have like one more restriction.
Yep.
1 year, only certain models. Yeah.
It's use it or lose it.
Yeah.
If you put money in there and you don't spend it all that year, you lose it. You lose whatever you didn't spend.
So why would people use that one for cheaper? It's cheaper, you don't pay tax, and then you have a grace period.
Yeah, so it's an option, but it is a little stressful. And you might find people that are like, man, it's the end of the year, I need to go get some medical treatments before I lose my money. All right. There are critical illness policies that cover a specific illness. You can get, for example, a cancer policy or a heart attack policy that will provide you money specifically if you get that illness. Even if you already have health insurance, this would provide you additional money. And to me, I never really thought that this made a lot of sense personally, but then a brother-in-law of mine bought one of these policies. He bought a cancer policy because he had a friend who was selling these policies and he just wanted to help his friend out. He said, sure, go ahead and sell me a cancer policy. Well, my brother-in-law then developed cancer, throat cancer, actually, which, and the treatments for that were horrific. They had to point a laser directly at a certain spot on his throat, but he couldn't move because they only wanted to get that one spot. So during his treatments, they would, he'd be on the table, they'd have to secure his face so he couldn't move at all for half an hour or so as they pointed a laser at his throat. Can you imagine? But he bought this policy just to help his buddy and ended up being able to use it. And I think it paid him something like $45,000 that he was able to use for his medical costs or however he wanted. So if you know in your family there's a history of a certain illness, that might be something to consider. But hopefully whatever health insurance you have, hopefully you have health insurance, and hopefully it would cover most of the costs of any kind of illness. There are long-term policies. These are not as common as they used to be because it's gotten so expensive. But when people get to the point in their life where they can't take care of themselves completely and they need some help, or maybe they need to move into an assisted living facility or a skilled nursing facility, that gets really expensive. And these policies help address those costs. But again, they can be kind of expensive. Unfortunately, a lot of families that don't have these long-term care policies end up just having to take care of grandma or grandpa, right? Just at home. And that's tough. I had to do that for 1 week when my stepfather was ill. There were 4 of us, and it was still hard taking care of him. We were taking shifts, and we'd have to lift him up together. Fortunately, he got better after a couple months, and if we had to, on a long-term basis, continue providing that support, that would have been really tough on the family. So long-term care policies help pay for those kind of services to help, pay for someone to come in and take care of a family member. Now, if you are going to be traveling internationally, you might consider travel insurance policies. They're typically not that expensive, like $50, $100, something like that. But they can help cover medical costs while you're away, out of the country. They can also cover other things. Sometimes they'll cover medical evacuation if you have to be evacuated out of the country. They might cover if your luggage is lost or your flight is canceled. So if I'm traveling internationally, I'll usually get one of those. And I have had to use them a couple times. Like one time, my wife and I had a trip to Paris planned, and it was during we were coming out of the pandemic, things were getting better, but our trip was scheduled right when things got really bad in France. COVID just ballooned. They shut down all the restaurants, all the museums, and we're like, why go? We're just gonna walk around the street and not do anything. So we canceled, but it took a long time. It took a lot of emails and phone calls, but I finally got reimbursement for that flight through the travel insurance. Jahira?
Is the travel insurance like a one-time usage thing, or is it
you
It's,
haven't
it's
included-
usually for one trip, and I think they can go up to 3 months. So like, let's say you're planning a trip where you're gonna be backpacking through Europe. You could set it up where it would cover the whole thing, but if you're gonna be there longer than 3 months, then you'd probably have to get a second policy, the second half of the trip.
should make sure what they're covering.
Mhm.
My husband and I, we were in France and we bought a package from the travel agency
Mhm.
there to go to Portugal. And they're like, yeah, you have health insurance. And then when we wanted to use it, they're like, oh no, you can't use it because you're American.
That's what the people in Portugal were telling you?
No, in France, the agency who
Who sold you the policy?
100%. So my husband is like, oh, hell no. So he called the credit card and complained and they actually, the agency got screwed because the credit card reimbursed us our entire amount of the package.
Ah, okay.
So.
Yeah, that will teach
Yeah.
them a lesson.
100%, but you should just make sure because it's like they took our American dollars, but then they're like, oh no, we're not covering you because you're American. And they never told us that. They literally sold it as like a benefit, but then we went to use it, they're like, no.
Yeah, so you do have to know what the policy does and doesn't cover, and it gets complicated. But, and it can be a hassle to get reimbursed, but still, from my experience, I used it that one time. Also, when my daughter was in Brazil, she needed some medical care while she was down there. I think I spent $50 on that policy and they ended up reimbursing us about $400 for medical costs. So in general,
And you had to
It
pay
can
out
pay
of
out.
pocket first, right?
yes, and then get reimbursed.
Okay.
Yeah, it was a pain. It was a pain. Yeah.
So did you get the travel insurance while she was already there or before?
Before, yeah, you have to get it before the trip. Now there are these cost sharing programs out there for medical insurance, but it's not insurance. You might have heard commercials sometimes. I hear them on the radio. Well, a lot of times it's a church-based thing too. We're not insurance, we're MedShare or something like that. You know, we are people taking care of people. Well, because it's not insurance, it's not regulated. So you can put your money into one of these programs, and then if you get sick, hope that they're actually going to pay for your medical care. But yeah, there's no guarantee that they will. So I would avoid anything that's supposed to be like insurance, but isn't insurance. Because insurance is heavily regulated. They have to follow very specific procedures. Okay, so any comments or questions on health insurance? I know it's a big topic. I think those are some of the key points. There is disability insurance. If you are unable to work because of a short-term disability, you can contact the EDD, the Employment Development Department here in California. Same place that you would contact to put in an unemployment claim if you got laid off or something. They also handle short-term disability. So this came up, I think it was about a year ago. My wife couldn't work for about a month for medical reasons. So we filed a claim with the EDD. I think they have a 9-day period before you can start getting any income. But then if it's approved, they start sending you money for the period of your disability up to a certain limit. And it's not the full amount you would have earned at work, but it's something.
Were you taking care of her? Because you could have gotten money for that.
No, I wasn't. I mean, a little bit, but I was at work most of the time. I was
My
here,
dad
so.
got out of hospital, I got a note from the
Uh-huh.
doctors, so I got paid.
Oh, okay, yeah, that's true. Sometimes if you're the caretaker, you can collect for that as well.
You just need a doctor.
Now, if it's a long-term disability, you can apply to the Social Security Administration. That's part of what we pay our Social Security for. So if it's something that's going to be going on for years, where you're going to need some income, that might be covered on your own Social Security. Now, you can also buy your own disability insurance. from my experience, not that many people actually do that. But imagine you've gone to college for years to become a surgeon. And as a surgeon, you're making $500,000 a year. But if something happened to your eyes or your hands, you couldn't do surgery anymore. So you might then get disability insurance so that if that were to happen, you'd still have that income that you're used to, even though you're not able to work. The interesting thing is, I've heard you just can't work in that profession. But let's say you could go become an actor or go do something else, become an engineer. You could still get your disability income and go do that other profession. But anyways, like I said, not that many people from my experience pay for disability insurance, but it is an option that's out there. All right, let's see what else we got here. Property and casualty, okay. So we'll talk first about homeowners and renters insurance, and then we'll talk about auto insurance. Now, if you own a home, chances are you have a mortgage. And the mortgage company requires that you have insurance on the home. Even if it's not required, it would be a good idea, right? Because the house, let's say, were to burn down, or there were an earthquake or something like that, to repair it could cost hundreds of thousands of dollars, right? So it typically makes sense to insure your home. What about if you're a renter? You're not really worried about the building because you're renting the building, right? But you still have your personal property in the building. And there are other benefits to having renter's insurance. Sometimes the landlord will require it from the tenants, but even if they don't, you might want to consider, if you are renting, even if you're only renting a room, you might want to consider having a renter's policy. So let's look at what these policies cover. If it's a homeowner's policy, obviously it covers the home, right? So if something like this happens, it pays to rebuild the home. And the insurance companies keep track of what they estimate your home to be worth and how much it would cost to rebuild it. So as home prices go up, the cost of your insurance tends to go up as well. So that hopefully, if something like that happens, policy will cover. Now, you might have a deductible, but other than that, it'll cover the cost of repairing or rebuilding your home. It also covers personal property, and that applies also to renters' policies. So let's say you're renting a room somewhere, the room floods and destroys your stamp collection that's worth $10,000. Well, if you had renter's insurance, that might be covered. There are a lot of details in insurance policies. So it might be covered, it might not be covered. What I would recommend, if you do have anything especially valuable, any kind of collection, artwork, I don't know, guns, a pit bull, these are some of the things that might not normally be covered under the policy. So you would talk to whatever agent signed you up with the policy, and they might be able to add special coverage for that collection or pit bull or whatever. Now you might even be thinking, why would a pit bull be covered in a home or renter policy? Well, it's not the dog that's covered, but what if that dog bites somebody? Are you covered? If they sue you, you might be covered under your policy. That is liability. Whether it's a home policy or renter's policy, it will include some personal liability coverage. This covers injury that you have caused to others. Doesn't have to be physical injury. It could be psychological injury. It could be they feel their reputation was harmed, any type of injury that you're accused of having caused might be covered under your home or renter's insurance policy.
How does someone prove that you like psychologically or like if
Let's say you posted something online and somebody says, Jahira bullied me, and I'm suing for defamation because it wasn't true. Okay, now you have to go to court. Your insurance policy might pay for your lawyers to go and defend you in court against these allegations. Who would have thought your home or renter's policy would cover something like that? Or your dog bites the mailman or mailwoman, right? Are you covered? Maybe under your renter or homeowner's policy. By the way, pit bulls are usually excluded. That's why they came to mind. Some insurance companies, if they know you have a pit bull, they're like, no, we're not going to cover you. I know they're cute. I know they can be the best pets. I've heard that, but they also bite. Christine. Yes. Yes. Good question. So the landlord has insurance on the property and you have renter's insurance. And if somebody gets injured, whose policy? Well, it kind of depends on who's considered to be at fault. If they didn't take care of the stairs and that's what caused the injury because the landlord didn't maintain the stairs, it's going to be their policy. Now that person might sue you as well, but you really had nothing to do with it, right? So you'd probably be off the hook. But let's say, you know, this person was visiting and you dropped the cigarette and caused a fire. Maybe it's on you then, right? So it kind of depends on the circumstance. So interestingly though, this personal liability is not only related to the house, it's any injury you might have caused anywhere in the world, again, even online, could be covered on your home or renter's liability. Now, if the home is flooded or if there's an earthquake, those are not covered on home and renters policies. It's a separate policy that you have to get on top of what you would normally have. And some people don't realize that. So the normal policy covers things like fire, vandalism, theft, things like that, but not flood and earthquake. And sometimes it's tricky, what's a flood? If there's water damage, was it from a flood or was it from some other factor that let the water come in? And the insurance company is who gets to decide that. If you disagree, if they say that was caused by flood and you don't have a flood policy and you feel like, no, it wasn't a flood, it was a crack in the wall that let the rain in, you know, then you've got a dispute. And if you can't resolve it with the insurance company, you can go through, you know, you can make a complaint to the Department of Insurance and maybe get it resolved. Oh, it's a good idea, whether you have insurance or not, but especially if you have insurance, I'd say at least once a year, walk through your home, just turn the video camera on your phone, walk through, video what you have. What's in the closets, what's in the drawers, because let's say that there's some major damage. And the insurance company says, okay, what did you lose in this fire? Whatever I had. They're like, well, we want to see a list. How much was it worth? Do you have the receipts? You know, the more detail you can provide, the more money you'll get back from the insurance company. Understand? Yes. Maybe. Maybe. I mean, hopefully the landlord's insurance policy would cover it. But again, The contract language on the insurance policy can be very specific, and they've got lawyers that will say, well, you know, we think there's an exception here, so it's really hard to say. Yeah. Oh, one other thing I'll mention, let's say you go over to a friend's house and you're just gonna be there 5 or 10 minutes, so you leave your laptop in the car. You come out, laptop stopped. You call up your auto insurance and say, hey, somebody stole the laptop out of my car. They'll say, it's not our problem. If you have renters or homeowners insurance, that covers your personal property even when it's not at home. That might cover the theft.
That happened to us. It does cover it because your auto insurance doesn't cover anything valuable in the car.
Mhm.
But my husband, it was at our home, but still, like, he forgot to lock the car doors
Mhm.
and, there'd be like walking around. They took everything out of his, car. Like,
Yeah.
they even took stuff they didn't need, like the registration paperwork. Like, why do you need this? But
Mhm.
now I've always had renters because it didn't cover that.
Yeah, so to cover your personal property, now there's probably a deductible, usually with insurance, there's some deductible. So it only covers the amount above the deductible. So let's say you had a $250 deductible and it was a $500 laptop. They're not gonna cover the first $250, but they'll cover the rest. So it's better than nothing at all. Okay. Any questions or comments about homeowners or renters insurance? All right, let's talk about car insurance. Now, from my experience, most people don't understand their car insurance. But hopefully, after today, you will understand. Okay. Oh, by the way, both of these, home and car, fall under property and casualty because they cover your property, your home, your personal belongings, your vehicle. But they also cover the liability. So that's what's meant by casualty. So same thing here with auto insurance. And that's why it's kind of complicated. There's so many parts to it. First of all, don't assume that anybody who drives your car is covered. It might be, it might not be. It depends on your policy. If you've got somebody that uses your vehicle regularly, you probably need to have them listed as a driver on the policy to make sure they're covered, which might increase the cost. It might decrease the cost if they are, you know, an older person with a long driving record, that's a clean record, and especially if they're a professional, because your career makes a difference in the price. It might actually lower the cost of coverage. It just depends. It gets complicated, but you don't want to take the chance that somebody's using your vehicle and they're not insured, or that you're using somebody's vehicle and you're not insured. Don't just assume that if you drive somebody else's car, you're automatically covered. Maybe, maybe not. Okay, so one part of auto insurance is bodily injury and property damage. This would be if you were to cause injury to another person that's not in your vehicle, or if you were to damage somebody's property. And this is required by law that you have this coverage. Does anybody know how much coverage you're required to have here in California for bodily injury? It's $15,000 per person and $30,000 per accident. That's a maximum of $30,000 per accident. That's required as the minimum. It's kind of confusing, but is that enough? If you cause injury to somebody else, I mean, one night in a hotel, in a hospital, Could be $50,000, could be $100,000, right? And that's just for one person. What's that?
Depends on their injuries.
Depends on the injuries, right? And $30,000 maximum might not be enough, especially if there are multiple people in that other vehicle. So the legal minimum of $15,000 per person and $30,000 per accident is a very low amount. I would encourage having a lot more coverage than that. And then $5,000 of property coverage. Somebody rear-ended me recently. I don't know if I mentioned that to y'all. I was just stopped at a stoplight and hit me. Wasn't that hard, but just to replace the bumper, $2,200. Just the bumper.
You have fancy car drivers?
No, it's a Chevy.
Is it because you have a, what is it, the fiberglass bumper, so it just got smashed?
I think most cars, that's what it's gonna cost to replace a bumper these
Yeah, that's
days.
the problem.
Yeah. I mean, there's a camera back there and some sensors and
Oh,
stuff,
that's,
you know.
yeah. And I like barely tapped the car the other day, and like, yeah.
Was it you? Did you hit me?
No, no, it was a police station of all places to my, oh my God. But just barely tapped that, I was reversing, and my bumper in the back was like if you hit something.
Oh,
like,
no.
just, oh, I barely,
How about theirs?
huh?
How was their bumper?
They had like some kind of, it was like a SUV, so they had like something, or it was a like fiberglass
Okay,
one.
right.
They
So
were-
just messed up your car.
Yes, I didn't need to leave the note, which is good.
So the point is $5,000, probably not enough coverage, right? I mean, imagine you have to replace somebody's Tesla or something. That's gonna cost a lot more than that $5,000, right? Okay, so that's the bodily injury and property damage coverage. Then there's comprehensive and collision. Now, that's not required by law. Who can tell me what does this cover, comprehensive and collision? What's that? So it covers the damage to your vehicle that you caused in an accident. That would be the collision portion, right? So the property damage is the damage to the other vehicle or building or whatever it was that you caused. But damage to your own vehicle that you caused would be collision. And comprehensive would be things like if your car got stolen, if a tree fell on your car, so various other things that could happen.
Is that the one that is comprehensive?
Both of them have deductibles, yeah. So that's one thing you can do if you want to lower your monthly cost or your annual cost for insurance. You could have a higher deductible, but then if something happens, they're gonna cover less. So personally, I think it's a good idea to have a lot of liability coverage. And don't worry so much about covering your car. If something happens to your car, you know, that's not that big of a deal, right? I mean, it is, but not compared to if you have to pay out $100,000 for somebody's medical costs. So if you had to save money on your policy, where I would do that is raise the deductible. Understand?
So I heard that, some insurance.
There's rain. I've never heard that before, so which one? I've never heard that. It might be a thing, but has anyone heard that before about insurance that does not cover you when it rains?
No, that's part of their.
Yeah.
So most accidents happen, it's when it's raining. After the first
Yeah, so I would look into that more because that seems a little weird.
Just in general.
Another part of the auto insurance is the uninsured motorist. This covers you if somebody hits your vehicle or injures you, and they either don't have insurance or don't have enough insurance, then your insurance will kick in the difference. Or if it's hit and run. That happened to my son. Did I tell you all that story? He was on a skateboard, an electric skateboard. That was his method of transportation when he first moved up to the Bay Area. And, you know, I said, as long as you wear a helmet, you know. But still, I was not real comfortable with the whole idea. Well, he is going through an intersection on his electric skateboard. He has a green light, but this car that was coming the other direction decides they're going to cut him off. And they came from the outer lane, just made this really rapid turn in front of him. And so, fortunately, didn't run over him because it could have been really bad. But fortunately, he couldn't stop himself fast enough with the skateboard. They have a remote to slow it down, but skateboard, it's not going to stop like a car would. And so he had to put out his hand to avoid hitting the car as it passed in front of him. And then he ended up with titanium plate. Yeah. When this happened, now I had written the policy actually because I had opened up his car policy when I had my farmer's agency. I made sure it was a really good policy, that it had full coverage for him. By the way, people use that term full coverage, and usually what they mean is that they have comprehensive and collision, but there's no such thing as full coverage. But I made sure that it had all the coverages and a good amount of coverage. So I made sure that there was uninsured motorist coverage. But I wasn't sure if it would apply because he was on his skateboard, he wasn't in his car. So I called the agency, because I had sold my farmer's agency to somebody else. And then he sold it to somebody else. So I called my agent and I said, hey, this is what happened. Am I covered? And it was actually an employee of hers. And he said, I don't think so. And I said, okay, but I want an answer. I don't want to, I want to know yes or no. So anyways, I ended up filing a claim. And fortunately, even though he was on the skateboard, his uninsured motorist coverage covered him. Because the car that he smashed into didn't stop. There were 5 witnesses, nobody got the license plate. So it was a hit and run. But it was covered. Farmers covered it. And I've been told that most insurance companies would not, if you're not in your vehicle, but Farmers policy, even though he was on a skateboard, they paid him $80,000 for his medical expenses. Yeah. Now, we had health insurance. He was on our health insurance plan, and Blue Shield or Blue Cross, whatever it was at the time, covered his medical expenses. So when I called the health insurance company and I said, you know, exactly how much is the total, because I need to let farmers know how much to send you. And this is really, really rare. My son got super lucky. I mean, the accident was unlucky, but insurance is supposed to recover what you lost, right? It's not supposed to be a benefit. Well, Blue Cross or Blue Shield, whichever it was, said our policy is, in this sort of a case where it was an uninsured motorist situation, we do not need to be reimbursed. I said, wait a minute, the Farmers is going to pay. And they said, no, your son can keep the money, consider it, you know, compensation for his emotional distress. So the lucky duck then had enough money to buy a car because his skateboard was in 2 pieces. It did not survive the accident. Oh, and here's the part. Okay. When he called us from the hospital, he's a smart kid. He knew to call me, not my wife, because she would have freaked out. And I freaked out too, but I kept it inside, like we males tend to do, right? So he called me, and this is exactly what he said. He said, Dad, I'm okay. The first words out of his mouth, I'm okay. I'm like, okay. And he said, I was hit by a car. I'm glad he started with I'm okay, right? And technically, he hit the car, right? He wasn't hit by the car. But anyways, I didn't know that at that point. He said, I'm okay. I was hit by a car and I broke my arm. So I was like, okay, that's traumatic to hear as a parent, but at least it's only his arm, right? So we go up there. This was 9 o'clock at night that he called. So we go all the way up to Oakland. It's like 11 o'clock already. And poor guy, he's sitting there, and man, his arm was a mess. Looking around like, where's your helmet? Is your helmet in there? I didn't want to bring it up, but after he'd recovered, I asked him, he's like, yeah, I wasn't wearing my helmet. The smart kid, but sometimes not that smart. Thank goodness he didn't end up with a head injury. So anyways, uninsured motorist covers if you are injured or your property is injured by somebody else and they don't have enough coverage. It's not, right? A lot of people don't have that on their policy, but I would certainly recommend it. Then there's umbrella insurance. Does anybody know what umbrella insurance is?
Covers it all, bundle.
Right. And this is not anything to do with the rain, by the way, Christina. So umbrella insurance gives you additional liability coverage. So if you do cause any kind of injury to somebody else or their property, either with your vehicle or any other way, even this personal liability that covers defamation and any emotional injury, all of that. If you buy an umbrella policy, it gives you additional coverage. So typically, people have usually about $100,000 of liability protection, maybe 200,000 or 300,000. Umbrella policies increase it by $1 million at a time. And they're not that expensive. So, like let's say at some point in the future, you've got a nice house, you've got a business that you own, you've got assets that if somebody sued you, you could lose. Having an umbrella policy helps protect you so that if you did lose a lawsuit where you were found liable, it might provide millions of dollars of coverage. So you don't have to pay out of pocket.
That's in addition to your auto insurance.
Yes, it doesn't come with, I mean, there would be some liability coverage, but this is additional. So, yeah, so you can buy that on top of it. And it might be like $500 a year or something, so it's not super expensive. Okay, this is the last slide of this section. Any questions on the property and casualty insurance?
It's nice how you like relatives to San Francisco and on the bike.
Wow.
That happens all the time. They had one in Harris Plains where they hit the bus driver, the dad. I mean, I don't know. And he died too.
Yeah, I actually have a friend in Monterey, got run over by a truck. Really sad. Tragic, right? And then the insurance company pays out the family. I think in my friend's case, her family got $5 million.
Yeah, and it's hard to find the people because there's no cameras and witnesses.
Yeah. Yeah, when I got rear-ended recently, I was worried that the person wasn't going to stop and I wouldn't be able to get their license plate information, but they did. They stopped. Sometimes they don't. All right, well, a couple other things. I know you all are young and probably not thinking about this kind of thing, but there might be people in your life who maybe should be thinking about these kinds of things, and there might be a conversation to have at some point. So it's advisable everybody has a will at some point in their life, because that provides some direction about what should happen after your passing. For example, you can specify in your will who you want your assets to go to. And who's going to be in charge? Who's the executor or executrix? Executor is male, executrix is female. So who's going to execute that will and make sure that whatever you have specified is what happens? That's just common, everybody should have it. Some people have what's called a living will, so that if something happens and you end up in a coma where you can't really make decisions, right? Who then can make decisions on your behalf? So you can give power of attorney to somebody to take care of your finances. You can give power of attorney to somebody for legal decisions and medical decisions. So these are things you can specify. And the more assets you have, the more, the bigger your family is, the more important it is that you've got these sort of things in place. Yeah. Say a little louder. As far as I know, if you have personal debts that you haven't paid off, it does not pass on to your family members. But if you have shared debt where they're on the loan, then they would be responsible. Do you have anything to add to that from your experience in banking?
I think it's just like because you can't pass any debt on unless, because the hospital, my sister was a little bit concerned with my dad's debt with the hospital. That she basically like inherited him for his direct. So, but that was a very specific.
Yeah, in general, your personal debt would not be somebody else's responsibility, but Emma brings up a good point, because in California, if you're married, then it's considered you have shared assets and shared liabilities. There might be some exceptions, like in a prenuptial agreement where you separated them, but that could be an issue, where the spouse inherits the debt.
They will.
Don't get married,
Yeah.
or don't go into debt.
Right. Or just make sure they're not hiding debt behind your back. I had a customer, you're laughing, right? I had a customer who came in who was literally in tears because he couldn't stop his wife from spending, and he was like, what can I do? I'm like, bro, you can't do nothing. She's allowed to open a credit card if you max it out if she wants to. I'm like, you can get divorced.
Is that what you told him?
Well, yeah, what am I supposed to tell him? Legally, what are you gonna do? You can't stop her. She's her own person. Like, you can't make her like, no, you can't have this credit card. Like, how is he gonna enforce that?
I have a question. What if a person had like no other person to appoint those responsibilities to?
Okay.
Would that go to like the state or?
Yeah, exactly. So if you don't have a will, then your assets go through probate court, and the judge gets to decide who gets your assets. And perhaps who's going to make certain decisions on your behalf as well, if you haven't specified that.
Or doesn't power of attorney apply to like if you go into a coma too or something?
Yeah, that would be the medical power of attorney. So that's who can make your medical decisions on your behalf. Oh, wow, that's many hands. So Christina and then Emma. Well, what would probably happen is the judge would award those to the kids, because they would be the most direct, beneficiaries. But if they're minors, then there'd probably be somebody appointed to manage those finances for them. So if you haven't specified an executor or executrix, then the state makes that decision.
Historian about and set that up with your doctor's office specifically. Like, will doesn't always apply to everybody, but you're directed. You can set that up with the hospital or your doctor, and it's free. You don't have to pay for that. And I highly recommend it because, like, my husband and I are different religions, So what I want when with my body, when I, like if you're an organ donor, like they don't believe in that in your religion, so
Mhm.
he wouldn't execute that. with me.
Really? In Islam, they don't?
Oh, no,
I didn't know that.
you
Interesting.
are not allowed to do anything to your body
Interesting.
when you
Okay.
die. Like, you have to go, like, it's like, you go as you came, like, no tattoos, no nothing, yeah.
Okay.
So, he like specifically told me, like, I will not let them do that,
Mhm.
so if that's something that's like important to you, then you can do it, so.
Yeah, yeah, so these are, these are important considerations, especially if you have strong religious convictions and you want certain things followed. I have heard of people that have like a do not resuscitate request, where they even keep that documentation on them. But that doesn't mean the paramedics are gonna follow that either, unfortunately.
It depends on the situation, but I would just tell it, because I just went through this last year with my dad dying. If you feel one way and you have siblings that don't, you really highly need to push your parent to do this, because my dad wouldn't, and my sister and I were constantly arguing about those type of things that do not. She has a different.
Yeah.
And it's really, puts pressure on you and doctor's office, because they almost couldn't have their own agenda too, so.
That's a
it
good
made it
point.
Way more complicated at the end, because
And really, that's what you're trying to avoid, is a situation where the family members are fighting over these things, right?
yeah, because it's so simple, you could just fill it out, instead of you want it,
Mhm.
get it. And my dad had 7 kids, like, we're all arguing about it, it was a total shit show.
So another thing you can do is set up a trust if you own a home. Or just if you have a large amount of assets, it's a good idea to have a trust, because what that does is it specifies what you want to happen with your assets, and it doesn't even have to go through a probate court at that point. And there can be certain tax benefits and legal benefits to using a trust. They're not necessarily cheap. It might cost $1,000 or $2,000 to set it up, but it just makes things a lot easier, for your family, if you can put things in a trust.
If you have simple assets, you can get free documents online that you
That's true.
can fill out yourself and have it memorized.
Yeah, you could do that. Yeah.
And then it's still the same, and you don't have to pay as much for because if you do the medical on your own with your doctors and do like some forms, then you're saving a ton of money.
Yeah, you could do a lot of this through something like LegalZoom, and it's not that expensive online, but then to make sure it's really done right, you probably want to have an attorney
You
that
have a lot of
knows the laws.
assets, but it's simple.
It's a good idea to also just keep a record of what are even for your own purposes, like what are all the different accounts I have? Who do I owe money to? What assets do I have? Believe it or not, sometimes people forget, they might leave a job and forget, oh yeah, I had a 401k over there. Whatever happened to that? Right? As you get older and life gets busier, sometimes you forget. So keeping track of those things, both for your own benefit and for your family members, could be useful. And maybe even including your passwords, because imagine, even if something, happened where you're in a coma for a week, but during that week, if your spouse can't get into the bank account because they don't know the password, it could be problematic. Now, you have to be careful with that, right? You don't want to share it with everybody, but social media accounts too. I can tell you one of my grandmothers, probably it's been a decade since she passed on. She still has a Facebook account. I've written to Facebook twice. They have a place where you can let them know that this person is deceased. And then they want you to provide a link to the obituary and and I've done that twice. And they won't take down her account. And the scammer could get in there and hack it, or all kinds of things can happen. Did you want to say something?
I had this happen before I left the bank, that the husband died, married couple, and she didn't even know all the accounts that they had because he was in charge of the finances.
Yeah.
So that really becomes important. But I was gonna say, instead of giving them your passwords, like, it's free, you can add anybody as a beneficiary on an account, and they will not have access to anything unless you're incapacitated or you die, because I had a husband who came in, his wife died, and she never added him as the beneficiary, and legally you have to wait 45 days before you can do anything on a bank account. And he was like super mad, and I'm like, it's not my fault that your wife didn't add you as.
Yeah, and you really should. Any banking or investment accounts, you should specify who your beneficiaries
And
are.
it's free, and it doesn't cost anything, and they will never have access to the account unless you add.
Okay, so any other comments or questions on risk management? All right, well, let me show you what we're going to do next. I'm gonna go ahead and stop the recording.